eTIMS is not a tax, it's just a software for invoicing and receipting, where we are just adopting technology to be able to use in form of generating our receipts. So we have the manual way in which we have been issuing cash sale receipts or invoices, but right now we are adopting technology to make sure that our invoices are digital. We can be able to transmit them via soft media, and people can be able to receive and use those invoices instead of printing, because we are promoting green technology. If you're in business, then you need to onboard on eTIMS so that you can record all your sales within eTIMS, and for those purchases that you're making, then also ensure that they are eTIMS compliant, because at the point of now doing your declaration, it's the two receipts which are both eTIMS compliant that you'll be able to use for your sales and purchases.
So far, what we can say about our progress, what we've managed to do is roll out the simplified solutions that are going a long way in providing the flexibility that we needed for this implementation to have all manner of taxpayers, all the spectrum of our taxpayers onboarding. But for this, the contribution that has come from this effort that has been put in by KRA is that we've managed to onboard on eTIMS, and eTIMS, we are talking about eTIMS and the simplified solutions that we have in place. We have around 110,000 taxpayers right now on board of eTIMS, and in total, in addition to the earlier numbers that we had for VAT, we have about 190,000 taxpayers that are on board all our solutions. But we had targeted 915,000 taxpayers in total with business income to onboard these solutions. So at this point in time, we have about 20% of our taxpayers on board. We're expecting more taxpayers to come on board in the course of this week. And the fact that we are talking about the 31st March deadline does not mean that it is the end of onboarding. The only thing is that we need all taxpayers to be on board so that they can support each other when it comes to accounting for expenses, especially when they purchase from each other in their income tax return when it comes to determination of their tax liability. Now, the clarification that we'd also like to give is that eTIMS is not a tax. It's a tool for collection of information for transactional data, sales and purchases. Every sale is a purchase for another taxpayer. So by us maintaining that information, that means that we make it more efficient when it comes to verification of tax liability. When taxpayers are filing their returns, there is available information that makes it easy for us to confirm that the tax calculations are actually accurate and the taxpayer has paid the right amount of tax. And the other thing that we'd like to mention is that we try to delink eTIMS and the income tax return filing, because once we receive the information, then when it comes to the filing season, there are taxpayers who, by nature of the amounts that they transact, will definitely be out of the tax net. Because if, for example, a taxpayer gets 24,000 a month when it comes to their business income, it means when they're filing their return, in the process of accounting for the tax relief, they find themselves that they're not subject to any tax. This means that any taxpayer who is earning less than 288,000 per year then will not be liable for any tax liability, but would need to account for their transactions through the eTIMS. What happens is that in all, we are in a self-declaration or self-assessment regime, and that goes also for invoicing. But that said, what we expect is accuracy, and what we are going to do also is when we are having the enforcement measures in place, then we'd be expecting that even as the taxpayers are in a self-declaration regime, they will actually take responsibilities as citizens of this country and account for the correct amount of, for example, the declaration when it comes to the transactions that they are declaring. We have a penalty outlined in the Tax Procedures Act, Section 86, that if one does not comply to the requirements of an electronic tax invoicing system, then they are liable for a penalty of double the tax due. But with that, also, when it comes to, I mentioned about business-to-business transactions, when you're doing business with the other person, they're expecting that you'll support their process of tax declaration, for example, for expenditure, by you issuing them with a valid electronic tax invoice. So if you do not issue the electronic tax invoice, that means this other person cannot also get the credit when it comes to expenditure claims in their income tax return. So the repercussions would be strained maybe business relations and not being able to do businesses at the right level, because everyone wants to get the credit and everyone just wants to pay the correct amount of tax, and it is by your compliance that they are able to do this. So they have a responsibility as themselves to declare their sales, but they are also depending on other business entities to support them on expenditure so that everyone just pays the right amount of tax. We don't have exemptions in terms of persons or entities, but we have exempt transactions. So an example of those are imports, for example. And imports, we always like to clarify, because at the point when someone is importing goods, for example, at the border, these transactions are being accounted for by our customs department, and therefore we feel that that record is sufficient to stand in for our visibility. However, once these goods come across the border, feed into the stock records of one entity, then anytime they're selling, they have to account for them with an electronic tax invoice. But we have others such as interest, we have emoluments. When you're being paid your salary, they don't have to go through the electronic tax invoice system. We have investment deductions and so forth, and then it says and similar payments. That means any transactions in that line might be a consideration for exemption, but with that you would need to seek clarification from KRA and a confirmed official communication to that effect that yes, your transactions are actually falling under similar transactions and therefore subject to exemption. So we currently have a USSD solution, for example, for the really lower end taxpayers who might not even have a smartphone. So they're using maybe a kabambe, they can use *222# and generate their invoices. But we also have a solution domiciled on the eCitizen platform, eCitizen at kra.go.ke, where if you have your login credentials for eCitizen, you can actually access and generate an invoice from the KRA services. In addition, we are rolling out a mobile app, currently working on have it hosted on the Google Play Store. So those 3 solutions are currently available. 2 are in use, 1 is in the pipeline. The other one that we are working on and is going to be a major game changer is what we are calling a reverse invoicing solution. Already, we have one of the farming sectors working on onboarding on this solution. How it happens is that if a taxpayer feels absolutely they cannot use any of the available solutions and they'd like to appoint one of their entities who is more capable technologically to generate the invoices on their behalf, then this person can be held responsible. Like this entity we are working with, they are integrating their system, because within that system, we can see the payments going to the farmer. So they are integrating their system with ours so that at the point where payments are being triggered, we have visibility of that data to us. But for us to be able to achieve this one for reverse invoicing, there's a bit of engagement that we need to have with the entities that are interested to understand the business model and to understand where the triggers are going to be for purposes of the invoicing to be done.